Hi, and welcome to the Formula Behind Wealth, the channel where we tell you how to earn the fine print so you don't have to fall asleep or work hard doing it yourself. If that sounds like your thing, stick around and hit subscribe. On June 12, 2026, Elon Musk rang the opening bell at the Nasdaq. And by the time the closing bell rang, he wasn't just the richest person alive anymore. He was the richest anything alive. The first trillionaire in human history. Not near trillionaire. Not trillionaire on paper if you squint. An actual full 12-0 trillionaire, all because a rocket company priced its shares at $135, and the internet decided that wasn't nearly enough. SpaceX opened at $150 a share. It touched $176 before lunch. By the closing bell, it settled at just over $161, which still left the company sitting at a market cap north of $2 trillion, making it the largest initial public offering in the history of stock markets. Full stop. Bigger than Saudi Aramco, bigger than Alibaba, bigger than every IPO that came before it, combined with most of your wildest expectations. And here's the part that should bother you a little. This is a company that lost almost $5 billion last year. So today we're going to talk about what actually happened on IPO day, why the stock ripped 19% before anyone outside Wall Street had a chance to blink, and why the same mechanics that just made one man a trillionaire are quietly about to put SpaceX stock inside your retirement account, whether you ever clicked buy or not. If you read the headlines, SpaceX is a rocket company that also happens to dabble in satellites and, more recently, artificial intelligence. That's backwards. Rockets are the smallest slice of this business, and AI is the part quietly eating everything else alive. Start with the rockets because that's the brand everyone recognizes. Falcon launches, Starship test flights, NASA cargo runs to the space station. It's the part of the business that built Elon's reputation, and it genuinely is excellent at what it does. Analysts at New Street Research have pointed out SpaceX holds something like a decade-long head start over any competitor in reusable launch. But a decade-long lead in rockets does not, on its own, justify a $2 trillion valuation. Launch revenue is real, it's growing, and it is nowhere close to being the reason this stock is worth what it's worth. Then there's Starlink, and Starlink is the actual machine. Tens of thousands of satellites quietly beaming broadband down to rooftops, boats, airplanes, and military installations, scaling faster than any telecom company in history has ever scaled. If SpaceX were just rockets plus Starlink, this IPO would still be enormous, but at least the math would make some kind of sense. Strip away everything else and you've got a wildly profitable space internet company riding a real growth curve. So what's the third piece? XAI. Musk folded his AI lab into SpaceX earlier this year in an all-stock deal, and the S-1 filing that came out in May made it pretty clear where the money is actually going now. Capital expenditures in the first quarter of 2026 alone came in north of $10 billion, more than double what the company spent in the same quarter the year before, and the filing points to artificial intelligence infrastructure as the main reason why. We're talking about data centers, GPU clusters, and a supercomputer called Colossus that's grown to roughly 1 million chips across multiple sites. Here's where it gets interesting though, because XAI isn't just burning cash internally. It's also become a landlord. Anthropic, yes, the AI lab reportedly signed a deal worth over $1 billion a month just to rent compute capacity on one of XAI's data centers in Memphis. Google followed with a similar arrangement worth several $100 million a month for its own slice of that same supercomputer. So now you've got a company whose own AI division is too expensive to compete head-on with OpenAI or Anthropic, but whose infrastructure has become valuable enough that those same competitors are paying it rent. Make of that what you will. And then there's the slide in the S1 that should have made more headlines than it did. SpaceX told investors it sees a combined addressable market of roughly $28.5 trillion across its businesses: broadband, mobile connectivity, advertising, and everything else it's quietly stacking under one roof. To be clear, addressable market is not revenue. It's not even a promise. It's a number of companies bankers calculate by adding up every dollar spent in every industry it could theoretically ever touch. Almost every company that's ever filed an S1 has a slide like this, and almost none of them ever capture more than a sliver of it. But slides like that are exactly what get repeated in every bullish headline the week of an IPO, because $28.5 trillion sounds a lot more exciting than we lost $5 billion last year. Put the three businesses together and you get a company that pulled in somewhere around $18.7 billion in revenue last year and still managed to lose almost $5 billion doing it. Musk himself posted that the combined company might be able to reach approximately $1 trillion in annual revenue by 2030. Might, approximately. Those are not the words of a CFO. Those are the words of a man who knows exactly how much weight his own tweets carry on a stock chart. Here's the number that should have been the headline, but wasn't because it's boring on a thumbnail. SpaceX's IPO was oversubscribed roughly 4 times over. Investors placed orders for somewhere around $250 billion worth of stock, chasing a $75 billion offering. Retail investors alone reportedly put in orders north of $100 billion before trading even opened, which is an absurd number for any IPO, let alone one priced at a company that's bleeding cash. That kind of demand doesn't happen by accident, and it didn't happen here by accident either. Back in March, Nasdaq quietly rewrote its own rulebook. Under the old system, a company had to trade for somewhere between 3 months and a full year before it could even be considered for inclusion in the Nasdaq 100, the index that triggers automatic buying from every passive fund tracking it. The new rule shrinks that waiting period down to just 15 trading days for large enough companies, 3 weeks instead of 3 months to a year. SpaceX requested early index inclusion as a condition of even choosing Nasdaq over the New York Stock Exchange, and Nasdaq said yes. Why does that matter? Because index inclusion isn't optional for a passive fund. If SpaceX gets added to the Nasdaq 100, every ETF and index fund tracking that benchmark is contractually required to buy shares, regardless of whether the fund manager thinks the stock is a good deal at $160 a share. It doesn't matter that Morningstar's own analysts put SpaceX's fair value estimate at $63, less than half of where the stock opened. It doesn't matter that CFRA slapped a sell rating on the stock with a $115 price target, implying nearly 30% downside from where shares closed on day one. None of that matters to a passive index fund. The fund's job isn't to decide if SpaceX is worth $2 trillion. Its job is to track the index, and the index now includes SpaceX whether the math works or not. This didn't go unnoticed. Senator Elizabeth Warren sent a 12-page letter to the SEC ahead of the listing, raising concerns about the valuation, the governance structure, and whether regulators had done enough to confirm that ordinary investors understood what they were buying into. She specifically flagged the question of whether index funds and other large institutional buyers were being adequately protected from a stock that was being fast-tracked into their portfolios. The letter didn't stop the IPO, it barely slowed it down, but it tells you the concern wasn't coming from outside the system, it was coming from inside the room. Here's the part that matters most for anyone holding index funds in a 401k or a retirement account, and it's the part almost nobody talks about until it's too late: the float. When SpaceX went public, only about 5% of the company's total shares were actually available to trade. Musk himself retained control of roughly 42% of the company, but thanks to a dual-class share structure, that translates into something like 82% of the voting power. Other early investors, venture funds like Founders Fund, which is reportedly sitting on a return north of $50 billion on its original stake, along with firms like Andreessen Horowitz and Sequoia, are locked up for 180 days before they can sell. Musk and other insiders agreed to a longer lockup, more than a year, before they can touch their shares. So here's the sequence to watch. Right now, demand is being manufactured at the top. Index funds forced to buy because of the rule change, retail investors piling in because they're loyal to Elon and don't want to miss the next big thing, and a tiny sliver of float making the stock easy to push around in either direction. Then 6 months from now, hundreds of billions of dollars in early investor shares come off lockup. A year from now, insiders can start selling too. The buyers were forced in early. The sellers get to wait and pick their moment. If that sequencing sounds familiar, it's because it's the same playbook nearly every hype tech listing has run for the last decade. It's just never been run at this size before. Early employees did extremely well. Reports suggest somewhere around 4,400 current and former SpaceX staffers became millionaires on paper overnight, with a few hundred crossing into the $100 million range. Venture firms that got in early did extremely well. Elon Musk obviously did extremely well, becoming the first trillionaire on the planet in the process. What's less clear is whether the people buying in now at $150, $160, or whatever the stock happens to be trading at by the time you watch this, are getting the same deal. Bulls will tell you to zoom out 20 years and judge it as a space and AI infrastructure bet, not a quarterly earnings story. Bears will tell you that a company losing billions of dollars a year, propped up by a fast-tracked index rule and a 5% float, is exactly the kind of setup that ends badly for whoever's left holding shares when the lockups expire and the manufactured demand runs out. Both of those things can be true at once. SpaceX might genuinely be one of the most important companies of the next 2 decades, and the mechanics of how it got priced into your index fund this month might still be a problem worth paying attention to. The two aren't mutually exclusive, and that's exactly why this story is more interesting than rocket company goes public, line goes up. If you want more breakdowns like this, the parts of the financial system that don't make for a clean headline but actually move your money, hit subscribe. Because this is far from the last time a fast-tracked rule change is going to land quietly inside your retirement account without anyone asking your permission first.